Hey guys, Rahul Shah here, trying to make investing accessible and profitable for the average investor. Now, if there's one thing that was there in the stock markets 50 years ago, if there's one thing that was true 50 years ago, that's true now, and that is going to remain true 50 years from now, it is that the stock markets will fluctuate. Share prices will keep moving up and down. And if you want to do better than the stock market over the long term, or if you want to earn good long term returns, you should know how to take advantage of these fluctuations. The fluctuations that are a result of people's tendency to speculate in the stock market and give in to emotions of fear and greed. And because of these tendencies, the stock prices or the stock market keeps fluctuating, and a smart, sensible investor or a trader should be able to take advantage of these fluctuations by buying after a stock price has dropped significantly below a certain reference point and selling after it has gone up significantly. Now, how do you take advantage of these fluctuations? How do you make sure that you pounce on these fluctuations and are able to generate good long-term returns in the stock market? Benjamin Graham was of the view that there are two methods of doing this. Two methods of doing better than the market or earning good long-term returns. Method number one answers to the name of pricing, where you try and calculate the intrinsic value of a stock and buy it only when the stock is trading at a significant discount to the intrinsic value, and sell it when it reaches an certain intrinsic value or slightly above that. Another method, he says, is that of timing, where you're trying to forecast the stock price, and if your forecast says that the stock price is likely to go up, you invest in the stock, and if your forecast is saying that the stock price is likely to go down, you sell the stock or you don't invest in the stock and wait for the stock to again start showing signs of an uptrend. So an investor is primarily concerned with pricing. He tries to arrive at the intrinsic value of a stock, whereas a trader is primarily concerned with timing. He is not concerned with the intrinsic value, even if the intrinsic value of a stock, if the stock is trading at a significant premium to the intrinsic value. However, if his forecast is saying that the stock price will go up, a trader will still go ahead and invest in the stock, whereas an investor will not invest in a stock if he thinks that the stock is trading at a premium to intrinsic value. So that's trading and investing. Two methods of trying to earn returns from the stock market. And one of the most popular forms of trading, of course, is charting, where you plot the stock price movement you plot the movement of a stock, price movement of a stock. You look at the historical price movement of a stock on a chart and try to arrive at the price that the stock is likely to trade a few days or a few weeks from now. So this method of stock price forecasting is of course known as charting, and it's one of the most popular forms of trading. Now, I don't know about charting much, I don't know about trading much, but I believe that over the long term, an investor is likely to earn better returns than a trader. There are certain inherent advantages when it comes to investing vis-a-vis trading that makes an investor likely to perform better than a trader over the long term. Now, what are these advantages that investing has over trading, and what are the disadvantages of trading or charting, if you will? Let's try and understand them one by one. Since charting is all about trying to forecast what the stock price is going to look like a few days or a few weeks or even few months from now, a chartist needs to guard his secret. If a chartist has arrived at a reliable way of predicting the stock price movement, and if he's been able to use it successfully in the stock market and earn market beating returns or good returns over the long term, then he should ensure that the secret does not come out, because if it comes out, if it becomes known to the general public, then that edge is gone. Everyone will try to follow the same method, and eventually that edge that a chartist has will go away, and he'll no longer be able to profit from his trades. A classic example was the Dow theory of investing, which was very popular in the early 20th century, and it seemed to work wonderfully well for a period of 20-30 years. But as the word got out, as it became more popular with the masses, everyone started using it, and it failed being a reliable method of stock price forecasting, or it failed in being a profitable method of trading or stock picking. If I were to give you an example, say take the example of 200-day moving average, which is a very popular technical indicator for I think a lot of traders. Now, if 70-80% of the traders start following the 200-day moving average for investing in stock, once a stock crosses the 200-day moving average, they become it's time to turn bullish on the stock and buy it. And once it goes below the 200-day moving average, it's time to become bearish. Now, if all the traders or most traders follow this technical indicator, what will happen is everyone will rush into buying the stock at the 200-day moving average, and it will push your average buying price higher. So if the 200-day moving average is 100 and the stock is 101, and if you go ahead and place a buy order, and if there are a lot of buy orders at this threshold, then instead of getting the stock at 101, 102 rupees, the demand is going to be so high that the price will be pushed to 110, 115 rupees. So that a few percentage points will make huge amount of difference over the long term. Say in investing, it's all about a few percentage points. You need to have that edge of few percentage points, and when that compounds over the long term, the difference in the results is going to be enormous. So even a few percentage point difference matters in investing, and when everyone starts following the same method, same trading method, that edge will narrow or it will go away. Likewise, if you are going out and selling the stock that is below the 200-day moving average, a lot of other traders are also doing the same thing. So your average selling price is also going to go a little lower than your expectation. If the threshold, the 200-day moving average falls, if the stock price goes below that and becomes 99 rupees and you place a sell order, there is a high possibility that you may not be able to sell at 99, but say 90 or 88 or 87 rupees, because everyone is rushing in to sell the stock. So the few percentage points difference both on the buying side and as well as on the selling side puts the trader at a huge disadvantage, and can really hurt his long-term return. So that's one of the major disadvantages of trading vis-a-vis investing. Second disadvantage, of course, is well known. Trading means frequently moving in and out of stocks. The turnover rate is very high, which means that you will incur a lot more trading cost as opposed to an investor whose holding period, who believes in holding on to a stock for a period of at least 1 to 2 years, or maybe even more. From the tax point of view also, trading is inefficient as compared to investing, because if you're holding something for more than 1 year, you pay the long-term capital gains, whereas if someone is holding on to a stock for less than 1 year, he has to pay a slightly higher tax rate, and he has to pay a short-term capital gain which is higher than the long-term capital gains. Of course, these days the trading costs have almost come down to zero, but there's still some trading cost involved, and because the turnover of a trader is very high, he frequently keeps moving in and out of stocks. He may have to incur a slightly higher trading cost as compared to an investor, plus he'll have to pay higher taxes also. There again, a few percentage points of difference arises, which can have a huge impact over the long term. Another big disadvantage when it comes to charting or trading, according to me, is I think a lot of people are attracted to trading because they believe that letting your winners run and cutting short your losses and letting your winners run is a very reliable strategy over the long term, because it allows you to stay invested in a winner for a long period of time, and it allows you to get out of a loser. It allows you to maximize your gains and minimize your losses. But I think even here trading is, I think, at a disadvantage when it comes to investing, because if you're doing investing properly, even if you're wrong, you may still end up earning positive returns. However, if you are wrong in trading, even though you're keeping a strict stop loss, but that stop loss will be kept at 15% or 20 percentage points of your buying price, or say 10 percentage points. So there's still some loss that you're incurring. However, when it comes to investing, even if you're wrong, and if you're doing investing correctly, if you're following the principles and you're applying it intelligently, you may still end up making money if you are wrong. Now, why? Investing is where you insist on a huge margin of safety. So suppose a stock has an EPS of 10 rupees per share, and you give it a price to earnings multiple of 12 times. The intrinsic value of the company is 120 rupees. Now, you're not going to buy the stock at 120 rupees. You will account for a certain margin of safety, and therefore you will buy the stock at rupees 60 or below. You're insisting on a 50% margin of safety. Now, if you are wrong, and if the stock does not earn an EPS of 10 rupees per share, but the EPS falls to 8 rupees, and the multiple that you give the stock falls to 10 instead of 12, your intrinsic value is still 80, right? It has fallen from 120 to 80, but your buying price is 60, and you're still making that 33% upside by buying at 60 or below and selling at 80. So here, even if you're slightly wrong, even if your estimates go wrong, you still end up making money in investing. Whereas in trading, if you're wrong, you end up losing money. Of course, these are subtle differences between investing and trading, but trust me, the small percentage point difference, a difference between someone earning 14-15% returns over the long term and someone else earning 17-18% returns or 19% returns over a period of 10, 12, 15 years, the difference is huge. Someone earning 18-19% can end up making a lot more money over the long term versus someone who's earning 12, 13, 14, 15%. And it is these small tiny differences and the advantages that an investor has over a trader, which I think tilts the scale in favor of investing. Besides, I haven't come across a lot of very successful traders. Maybe it is because of the fact that I'm an investor and I tend to look at investors more than traders. But there's certainly a lot more investors who've made it really big in the stock market as compared to traders, if you ask me. At least in my experience, I haven't come across a lot of very super rich traders or traders who've consistently beaten the market. Of course, there are winners in every field. There would be some very skilled trader who would have done really well in the stock market over the long term, but on an average, a person who's been able to consistently do well over the long term period, I believe has to is more an investor than a trader. And a lot of traders also follow certain investing principles in their analysis. They are not 100% traders, so even if they have achieved the success, it's because they've incorporated certain investing elements into the strategy, and therefore they have made the money that they have made. Likewise, for investing also, I think a lot of successful investors may have certain trading elements as well to the strategy. So it works both ways. But according to me, because of the disadvantages that I just highlighted and sound reasoning and logic that you apply and my own personal experience, I believe that you're better off investing in the stock market over the long term than trading. Of course, I think the major reason people are attracted towards trading is because it sounds easy to implement and the returns are also much faster. They perceive it to be a get rich quick strategy, plus it's easy to implement. But As you would be aware, there are no easy and quick methods, ways of getting rich anywhere else in life, and neither in the stock market. If making money is difficult, you have to assume that it's difficult, it's not easy. If it's sounding easy and if it's promising you quick returns, maybe that's not true. And a lot of investors fall into the trading trap because of this, I guess, because they perceive it to be easy and they perceive it as a ticket to getting rich faster, but that's certainly not the case. So these were some of the broad points that I wanted to highlight between trading and investing. What I would suggest is, if you want to do well in the stock market, if you want to build wealth in the stock market over the long term and keep it, then maybe 70-80% of your corpus should be dedicated towards investing, and you can trade in the remaining 10-20% and try and find certain method which helps you make money consistently via trading over the long term. Trading is not bad, but there are a lot of successful traders, as I said earlier, and traders do make money. But according to me, over the long term, an investor has a much better chance, or a better chance of making more returns than trading, because of the reasons I highlighted, and that's why I prefer it over trading. So if you have 100 rupees, maybe allocate 70-80% to investing and 10-15-20% to trading. So yeah, that's all from me today. Do let me know what you think of this video and whether I made sense, and whether from a long-term perspective investing has an edge over trading. What do you think of this conclusion that I arrived at? So till next time, goodbye and take good care of yourselves. Thank you so much. Bye.
Interested in potentially generating gains like 168%, 132%, 108%, and 104% in the next 1 to 2 years? Then click here to register for my upcoming Rapid Profit Summit on 12th July 2021.